something just happened that nobody in Washington is saying out loud. The tariffs landed. Economists braced. Markets convulsed. Headlines screamed collapse. And then the American economy looked at all of it, took a breath, and kept moving. Not by much. Not without pain. Not without warning signs building quietly underneath the surface numbers that the administration prefers to show you. But it moved. And that fact alone has shaken the assumptions of experts who were absolutely certain, that a tariff shock of this scale would crack the foundations of the largest economy on the planet within months of the announcement. It didn't crack, at least not yet. And the story of why it didn't crack, and why that doesn't mean what the White House wants you to think it means, is the real story of this moment. Because what is happening right now inside the American economy is not a vindication. It is a pressure test. And the hardest portion of that test has not yet arrived. Let's go back to April 2nd, 2025. Trump stands in the Rose Garden with a printed chart that looks like something assembled at a campaign rally. He calls it Liberation Day. He announces sweeping tariffs on virtually every trading partner. The United States has a 10% universal baseline, with rates climbing far higher on China, the European Union, Vietnam, Japan, and dozens of smaller economies. The kind of tariff wall the United States has not erected since the early 1930s. A trade policy reversal of historic proportions, executed in a single afternoon. Markets did not wait for analysis. The S&P 500 shed trillions in capitalization over 48 hours. Bond markets moved violently. CEOs began emergency calls to boards, to supply chain managers, to legal teams trying to figure out what their cost structures actually looked like now that the tariff schedules had been rewritten overnight. Retail executives who had spent years optimizing global sourcing suddenly faced a fundamental question about whether their entire business model was still viable at the new import cost levels. And economists began issuing warnings that were, in some cases, close to apocalyptic. The word stagflation appeared constantly. A 1970s-style scenario where inflation rises and growth slows simultaneously, trapping the Federal Reserve between impossible policy choices. Some projections showed GDP contracting. Some showed inflation surging back above 5%. The worst-case models were genuinely frightening. Then the data started coming in, and it didn't match the worst-case models. Inflation held, not comfortably, not at levels Americans had grown accustomed to during the post-pandemic normalization. But the catastrophic surge that many economists projected simply did not materialize in the spring and early summer data. The headline CPI numbers were elevated. They were uncomfortable. But they were not the economic emergency that Liberation Day seemed to promise. Why didn't it happen? The answer involves several simultaneous forces that cushion the blow, forces that are real, that functioned as intended, but that are also temporary. And this is the critical distinction that separates what actually occurred from what the administration's spokespeople describe when they point to the inflation data as evidence that the tariff strategy is working. The first force is what economists call absorption. When tariff costs hit a supply chain, they don't automatically pass through to the consumer immediately. At each stage, there is a decision about who bears the cost. Foreign exporters reduced their prices to stay competitive rather than lose American market share. Importers accepted lower margins. Retailers chose to hold prices even as procurement costs rose. The cost didn't disappear, it was distributed across multiple parties, each absorbing a portion. This kept consumer prices lower than the raw tariff numbers predicted. But every party absorbing cost has a limit. You cannot run indefinitely at compressed margins. At some point, the math forces a reckoning. The second force is front-loading. In the weeks before and after April 2nd, companies across virtually every consumer category accelerated their import orders to beat the tariff schedules. Electronics manufacturers pulled forward quarter-long orders. Clothing retailers stuffed distribution centers. Auto parts suppliers maxed out warehousing. The result was a massive surge of pre-tariff inventory flooding in before the full rates took effect. Retailers had product on shelves. Supply chains had cushion. And because that inventory had been acquired at pre-tariff prices, the consumer-facing tags didn't reflect the new tariff reality immediately. Borrowed time, purchased in containers, and it worked for a while. The third force is behavioral. American consumers, having navigated the inflation cycle of 2021 through 2023, had already shifted their spending patterns. Brand loyalty weakened. Willingness to substitute, to trade down, to delay discretionary purchases increased significantly. When prices on imported goods began creeping higher, consumers adjusted. They bought the cheaper alternative, waited for sales, skipped the upgrade cycle. This suppressed inflationary pressure that would have appeared if purchasing behavior had remained unchanged. These three forces operating simultaneously created the resilience that surprised economists and delighted the White House. But here is the part that matters far more than the spring and summer data. That front-loaded inventory is running out. Absorbed costs have compressed margins to the point where further absorption is becoming commercially impossible for many companies. And behavioral flexibility has structural limits. People still need to replace appliances, buy clothing for growing children, maintain vehicles. The delayed purchases cannot be delayed indefinitely. Eventually, necessity overrides the preference to wait. Economists describe this as the pass-through lag. The full inflationary impact of a tariff shock does not arrive immediately. It moves through the supply chain over months, following the depletion of pre-tariff inventory and exhaustion of absorption capacity. Looking at the 2018 and 2019 tariff rounds, a fraction of the scale of Liberation Day, the measured lag ran between 3 and 9 months. The costs that entered the supply chain in April 2025 may be fully visible in consumer prices by late fall or early winter. The headline inflation data that the administration celebrates does not show the future. It shows the past, filtered through buffers that are now depleting rapidly. And this is not the only signal turning in the wrong direction. The July 2025 jobs report was the number that made economists who had maintained cautious optimism begin revising downward. Job creation slowed materially below expectations. The unemployment rate moved higher. Wage growth began to moderate in ways that carry different interpretations, but the most troubling one is also the most consistent with the broader data. When wages slow because businesses are pulling back on hiring in anticipation of weakening demand, that signals something serious building beneath the surface. The composition of the July data leaned toward that interpretation. In an economy where consumer spending represents approximately 70% of total output, any sustained deterioration in labor market conditions translates directly into slower GDP growth. And GDP growth in the first half of 2025 had already disappointed against the projections the administration used when designing its tariff strategy. The momentum has been decelerating with each passing quarter. The Federal Reserve is watching all of this with institutional concern its public communications consistently understate. The Fed's toolkit has two settings: raise rates to fight inflation, cut rates to support growth. These tools work in opposite directions. And the scenario the tariff shock has created, rising consumer prices alongside slowing growth, is precisely where those tools conflict. The Fed cannot simultaneously fight inflation and stimulate growth. It has to choose. And in the 1970s, when that choice last presented itself at scale, there was no good option, only decisions about which kind of pain to impose. Through summer 2025, the Fed held rates steady and deployed the language of patience. But the models inside the institution are becoming harder to run with confidence. Standard inflation frameworks don't distinguish well between demand-driven inflation, which responds predictably to rate increases, and tariff-driven cost-push inflation, where pressure comes from supply constraints rather than excess demand. The policy response to each is different, and in the current environment, potentially contradictory. The trade deficit told another story worth confronting. Trump's core argument for tariffs is that they would shrink the gap between what America imports and exports. The immediate effect was the opposite. The deficit widened sharply because the front-loading surge pushed import volumes higher before any correction could occur. The long-run arithmetic might eventually narrow the deficit if domestic production scales meaningfully, but that takes years of capital investment and workforce development. The short-run effect directly contradicted the stated goal. Meanwhile, retaliation has added costs that compound domestic pressure. China targeted American agricultural exports, squeezing farm communities that had supported Trump's trade agenda. The European Union moved toward counter-tariffs on American services and technology. The global trading architecture built over decades began reorganizing, creating deep uncertainty for businesses, making capital investment decisions in an environment where the rules could shift again without warning. So here is the honest accounting. The American economy demonstrated real resilience in response to a tariff shock of historic scale. It did not collapse. The worst projections did not materialize in the initial data. That resilience reflects genuine underlying strength, a labor market that was healthy at the starting line, consumer balance sheets with capacity to absorb elevated prices, corporate margins that could sustain compression for a defined period. But the forces that produce that resilience are finite. Inventory buffers deplete. Absorption capacity exhausts. Behavioral flexibility reaches structural limits. And the pass-through of tariff costs follows a lag, not an exemption. What the spring and summer data revealed was that the American economy can withstand the initial shock of dramatic trade policy change. What the fall and winter data will reveal is whether it can withstand sustained pressure after the buffers have run out. The jobs report is weakening. GDP growth is below projection. The Federal Reserve faces a dilemma without clean solutions. And the tariff costs absorbed in compressed supply chain margins are sitting in the system, waiting for the moment when there is no commercial choice, but to move them forward to the consumer price tag. The economy hasn't cracked. That is true, and it matters. But the test is not over. The cracks, if they come, will not announce themselves in advance. They will appear quietly in a jobs number, in a retail sales report, in a CPI reading that finally reflects the full weight of the new tariff schedule rather than the borrowed resilience of buffers now nearly gone. The American economy absorbed the shock of Liberation Day, but absorbing the shock and surviving the full duration of the pressure are different things entirely. What happens in the next few months will determine whether this period is remembered as proof that the American economy can withstand historic trade disruption, or as the moment when the resilience ran out. The economy held. For now, what comes next is the question.